Welcome back to the deep dive.
Yeah.
Today we're looking at a company that is, basically synonymous with entertainment itself, Netflix.
Yeah, for years they really defined streaming.
It set the pace for everything. But, when you actually dig into this new financial research report from late 2025, you realize something fundamental is happening. We're not looking at the same company anymore.
Not at all.
And that's why we really need to do this deep dive. The Netflix we all thought we knew is making this monumental, almost shocking pivot. It's moving from being, a pretty capital-efficient Silicon Valley tech company.
Right, focused on innovation, profitable growth.
Exactly. And now it's becoming this massive debt-leveraged media conglomerate. The whole game has changed.
The risk profile is completely different, and for you, the listener, understanding the shift is it's essential. So, okay, let's unpack this whole thing.
Let's do it.
You're really sitting at the collision point of these two massive forces. On one hand, you have Netflix's incredible operational maturity.
Right, the years of scale, the efficiency.
Yeah.
It's finally printing cash.
Massive cash flow.
Yeah.
But on the other hand, you have this incredibly disruptive, incredibly risky $82.7 billion acquisition of Warner Bros. Discovery?
WBD.
WBD. So
All right.
Our mission today is pretty simple, but it's critical. Using this research, we need to figure out if Netflix is still a wonderful company, which, historically it has been,
Sure.
and if its current stock price and this newly levered balance sheet, if they still justify that title, we have to weigh the quality of the business against the cost and the new financial risk.
Yeah, just to give everyone a sense of the scale here, let's start with a headline number from Q3 2025. Consolidated revenues hit an enormous $11.51 billion.
Just massive.
And that's not just, marginal growth. That's a robust 17% year-over-year increase. It tells you right away the core business is absolutely firing on all cylinders.
It is. And before we dive into the fascinating details behind that number, a quick but, very critical note.
Yeah.
We're guiding you through a pretty detailed financial report today. All the analysis, all the figures we're talking about, they're derived from publicly available sources. And this is really just for educational purposes.
Right.
So we have to be absolutely clear. This deep dive is not investment advice. We really urge you, the listener, to conduct your own due diligence. Talk to a licensed professional before you make any decisions.
Of course.
Okay, now, let's talk about those revenues.
Let's start with that operational story in Q3.
Yeah.
That $11.51 billion in revenue wasn't just a big number. It perfectly confirmed what management had been guiding for.
Yeah, they nailed it.
It signaled that their two big strategic moves, cracking down on paid sharing and rolling out the advertising tier, are really working. They're diversifying away from just relying on premium subscriptions.
And that is a fundamentally strong story. The top line is it's undeniable proof of their scale and their pricing power. But if we look at the bottom line, the profits, the quarter had this really fascinating piece of financial friction. The company reported diluted earnings per share, or EPS, of $5.87.
Okay, and that number fell a little short of the analyst consensus, which was $5.94.
It did, but more critically, it missed the company's own internal forecast by about $1 per share.
$1. When a company the size of Netflix misses its own internal numbers by that much, the market usually freaks out.
Usually. But in this case, the reason for the miss was so specific, and probably, I'd imagine, very frustrating for management.
Why? What was it?
It was frustrating because it had nothing to do with operations. The entire shortfall was caused by a discrete, non-operational $619 million tax charge.
Wow. $619 million.
Yeah. And it was all related to a historical dispute, a disagreement with Brazilian tax authorities that just finally came to a head in Q3.
$619 million just from one country on a single tax issue. That just vanished from their profit line. But hold on, if this was an ongoing dispute, doesn't missing their forecast by that much suggest they weren't on top of it?
That's a completely fair question.
Why wasn't that baked into the guidance?
Well, it really reflects the uncertainty you have with international tax law. So while the dispute was known, the timing of the settlement and the final amount, those things are often really opaque. They're subject to last-minute negotiation.
So just hit all at once.
Abruptly. But what matters for our analysis is the implication. This charge artificially pushed their reported operating margin down to 28.2%.
And their guidance was for what, over 30?
They guided for 31.5%, so it pulled it down significantly.
So if we just, theoretically strip out that $619 million penalty.
Which was a one-time thing, yeah.
then the operational success is clear. The underlying margins would have actually shown continued expansion.
Precisely. If you take away that specific regulatory hiccup, the inherent operational leverage, growing revenue faster than costs, would have been crystal clear. We would have seen robust margin growth.
It really just shows their discipline on content costs and how well the new ad and sharing initiatives are scaling.
Exactly. So the quarter was a massive operational success that just got kind of financially muddied by international tax friction.
And that friction really speaks volumes about the headwinds these global digital giants are facing. Okay, so moving from the bottom line to the strategic focus. The report details this critical shift in how Netflix even measures its own success. For decades, the metric was simple: subscriber growth. Growth at all costs.
Yeah, that was the startup phase mindset. High growth, burn cash to get bigger. That era is definitively over now.
Right. So Netflix took this crucial step earlier in the year to stop reporting quarterly net subscriber additions as a primary KPI.
A move that initially raised a lot of eyebrows. Analysts, they accused them of a lack of transparency because their models relied on those raw numbers.
But the company's reasoning, for a mature business, it's pretty sound, isn't it? They're shifting focus to profitable engagement.
That's the adult pivot, exactly. When you've already conquered the market, just adding your 301st millionth customer who costs you $100 to get and only pays you $7 a month, that's less valuable than keeping the 300 million you have and maximizing their lifetime value.
So what's the total number now?
They ended the period with an astronomical 301.6 million global paid memberships.
300 million.
That kind of scale just solidifies their position. They're not fighting for global dominance anymore. They have it.
And the metrics they're pushing now, this profitable engagement, it shows why the shift makes sense. It's about mind share, not just headcount.
Exactly. The report cites Nielsen data that completely backs this up. Netflix's share of total U.S. TV viewing time grew by 15% since the end of 2022.
15%.
And even in the super mature UK market, it grew by 22%. So they are penetrating existing viewing habits more and more deeply. They're not just selling a subscription anymore, they're capturing your time.
And more engagement justifies higher prices and reduces churn.
Which is infinitely more profitable than chasing, low ARPU subscribers in markets that are already saturated.
Let's talk more about that revenue structure, because the report really details a significant change. Netflix isn't a one-product company anymore.
No.
It's moving from being, 100% reliant on monthly subscriptions to what the report calls a dual-engine model.
And that transition is happening very, very quickly. Historically, they were pure play subscriptions. Now, if we look at the estimated revenue mix for fiscal year 2025, subscriptions are still the big piece, around 78%.
Still dominant.
Still dominant, but it's the non-subscription parts that are driving the new growth. And that diversification is the critical evolution here.
And the most exciting part of that, the piece that really brings Netflix back into the growth conversation, is advertising revenue.
Absolutely.
The report projects it's going to be 12% of the total revenue mix for 2025. How did this happen so successfully? They were so reluctant to get into ads at first.
It was a necessary and I'd say brilliantly executed U-turn. The ad-supported tier is proving to be a highly effective funnel for them.
A funnel? How so?
Well, management reports that in the markets where it's available, the ad tier accounts for over 50% of all new signups.
Over half?
Yeah. And that's crucial because it captures this huge group of price-sensitive customers, the people who might have just been borrowers before or who were just never going to pay the premium ad-free price.
And they're monetizing this budget-conscious audience incredibly well. I heard it's often more profitable than the standard plan.
That's the counterintuitive genius of it. They're using their scale and all that unique data to command premium ad prices. They're seeing really high CPMs, that's the price advertisers pay per 1,000 views, in the range of $55 to $65.
That's top-tier pricing.
It is. Only premium broadcast and streaming can get those rates. And because of this, the average revenue per member, or ARM, from the ad-supported tier can often be higher than the ARM from their basic ad-free subscriptions. Their cheapest tier might actually be one of their highest margin products.
That's a phenomenal reversal.
Yeah.
Okay, let's quickly touch on the scale again. That 301.6 million global members, what do the regional dynamics look like?
It's a complex footprint. You have North America, or UCAN, as the mature region, 84 million subs. Growth there is basically flat.
So it's all about raising prices.
It's all about pricing power. That's why the average revenue per user, the ARPU, is highest there, around $17.17. It's basically a utility in that region.
And then EMEA, Europe, Middle East, And Africa, that's the biggest by volume, right? 94 million subs.
Correct, for now. But the long-term growth engine is still Asia-Pacific, APAC. They're at 51 million subscribers.
But the revenue per user there is much lower.
It is. You see the price sensitivity. ARPU is around $7 to $8. So it's a completely different model in APAC. It's all about high volume, lower price points, often driven by mobile-only plans.
And before we get to their structural advantages, we have to talk about the paid sharing crackdown. The report called it a hidden inventory boost.
It's the perfect phrase for it. This was a brilliant high-margin move. The report estimates they converted over 20 million borrower households into paid units.
20 million.
Yeah, either through the extra member option or a brand new account. And think about it. These 20 million households were already using the service, consuming bandwidth, but generating $0 in revenue.
So converting them didn't require any new content or marketing spend.
Zero. It's pure, immediate profit leverage, a financial gift that just needed an enforcement mechanism.
That perfectly sets up the conversation about their wide economic moat. This is why it's so hard for rivals to compete.
Yes, there are three pillars, really, to their structural advantage, and the first one is the most powerful. Economies of scale in content.
Give us a sense of the scale of that spending.
Netflix spends roughly $17 billion a year on content, and that's before the WBD deal.
17 billion.
And to understand the moat, you have to see that as a fixed cost. It's like building a multi-billion-dollar highway. The cost is fixed. Now imagine a competitor, say Paramount Plus with half the subscribers, to offer a library that can compete.
They have to spend the same amount.
They have to spend that same $17 billion or customers will leave. And this is where the math just gets brutal for the competition.
Right.
Because the competitor has half the subscriber base, their content cost per subscriber is double what Netflix's is. This leads to massive per subscriber losses for that smaller rival, which they just can't sustain long term.
So Netflix's scale lets them spread that cost out over 300 million customers. It's a barrier you almost can't breach.
Exactly. And the second advantage is their invisible edge, the data-driven feedback loop.
This is their secret weapon.
Built up over 15 years. They don't just know what you watched. They know when you paused, what scene you rewatched, what you gave up on after 3 minutes.
And what time of day you want a documentary versus an action movie.
All of it.
Mm-hmm.
And this data can't be bought. It can't be easily replicated. It feeds their content greenlighting process so they have fewer expensive flops, and it powers that percentage match algorithm.
Which is really a retention tool.
It's all about retention. It surfaces niche content that's relevant to you, which reduces churn and increases customer lifetime value.
They know your viewing habits better than you do. What about the third advantage, the distribution network?
The global distribution infrastructure. It's often overlooked, but it's critical. Netflix is unique in its ability to launch a show simultaneously in 190 countries with full localization dubbing, subtitles, marketing on day one.
Like with Squid Game or Lupin.
Exactly. And that capability attracts the best global talent. Creators want that instant worldwide audience. It creates a virtuous cycle that strengthens their content pipeline. It's a massive logistical advantage that even Disney still struggles to fully replicate.
So the report makes it clear that while Netflix had the moat in distribution and scale, it always kind of lacked the intellectual property, the IP moat, that Disney has.
Right.
And that brings us to the monumental gamble they're making with WBD. This is the moment they try to close that gap.
This is the moment they attempt to fundamentally redesign their entire corporate DNA.
Okay, this is where the story shifts completely. From operational success to just massive strategic risk.
Cool.
The $82.7 billion acquisition of Warner Bros. Discovery is this direct, audacious play to secure an unassailable content moat.
Right. They aren't just buying more shows. They are buying forever franchises.
Harry Potter, the entire DC universe, and crucially, the prestige brand of HBO. They're buying history.
The strategic logic of getting that evergreen content is sound. The financial mechanics of the deal, though, that's what should keep every observer up at night.
This is the core transformation.
It is. The deal is structured with a staggering $60 billion cash component, and that is being financed almost entirely through new debt.
So this completely transforms their capital structure overnight. It takes a conservative tech company and just leverages it up dramatically. Let's make that real for people. What was their leverage before this?
Before the WBD deal, Netflix was very conservative. a leverage ratio of about 0.6 times debt to EBITDA.
Okay, so for every dollar of profit, they owed 60 cents.
Basically, they were essentially debt-free. It gave them enormous flexibility.
And after the acquisition?
That ratio balloons to a pro forma leverage of nearly 3.0 times. This is the birth of the debt monster.
$3 of debt for every $1 of profit.
Exactly, and that radically changes who's in charge. The debt holders now have a much louder voice in the boardroom. The immediate consequence is a painful increase in their sensitivity to interest rates and a forced, immediate suspension of their massive share buyback program.
For how long?
For at least 2 to 3 years. Every spare dollar has to go to repairing the balance sheet.
And the risk isn't just financial, it's political and regulatory. The report estimates there's a significant chance this whole deal could just collapse.
That's a critical short-term risk. Because of the sheer size and the market concentration this creates, the deal faces intense scrutiny. The report notes that figures like President Trump and the DOJ have flagged concerns about media consolidation.
So there's a higher regulatory hurdle than they might have expected.
A much higher hurdle. The estimated risk of the deal being blocked is around 50%. It's basically a coin flip for an $83 billion gamble.
And if that coin lands on the wrong side, if the deal is blocked, Netflix is still on the hook for a massive, non-productive loss.
A huge $5.8 billion breakup fee.
Wow.
Just think about that number. That's more than half a year's worth of free cash flow. Gone. Instantly. Just to pay a penalty for a failed deal. It would severely restrict their cash flow and just damage market confidence.
Beyond the money and the regulatory hurdles, the long-term risks are often the most destructive in these mega mergers, right? I mean, the integration, the culture clash, we all remember AOL Time Warner.
The report specifically calls out the cultural clash risk. Mergers of this scale, especially between tech and legacy media, have a terrible track record.
Because Netflix runs on that freedom and responsibility culture.
Yeah.
Silicon Valley style.
Exactly. It's data-driven, fast-moving, meritocratic. And that philosophy is in direct conflict with Warner Bros., traditional Hollywood studio culture.
Which is more relationship-driven, talent-heavy, relies on intuition.
And moves much, much slower. If you bring the Netflix ethos, where data decides if a show gets renewed, into a legacy studio that runs on decades-long relationships with writers and producers, you are creating massive friction.
The talent retention risk must be enormous.
Huge. If high-profile showrunners feel that Netflix's cost-cutting, data-driven approach is stifling creativity, you could see an exodus from HBO and WBD. And if they lose that key creative talent, the very content moat they paid $83 billion for just evaporates.
And the report mentioned two other external headwinds that are just constantly there, chipping away at margins.
Yep. First, foreign exchange volatility, a constant issue.
Because 60% of their revenue is international.
Right. They're paid in euros, yen, Brazilian real. But most of their production costs, especially for these big Hollywood assets, are in US dollars. So when the dollar strengthens, their international revenue translates into fewer dollars while their costs stay high. It's a constant margin compression.
And second, going back to that surprise Brazilian charge, the risk of global taxation is just always there.
Yes. That Q3 charge was a loud warning shot. As these digital giants expand, governments all over the world, India, France, Italy, are actively looking to capture revenue through digital services taxes and retroactive assessments. These are non-operational, unpredictable charges that can just hammer your net income.
To really appreciate this shift to debt, we have to understand how Netflix actually makes money in its current mature state. Their cost structure is the key.
It's the key to their operating leverage. It's characterized by extremely high fixed costs, but negligible variable costs. And that is the magic formula for generating exponential profit once you hit scale.
Okay, so let's break down the single biggest expense, content amortization. Why is a cost that totals billions of dollars considered fixed?
Because it's a sunk cost.
Oh,
Once
yeah.
the show is produced and that check is cut, the cost is locked in. Whether The Witcher is watched by 10 million people or 100 million people, the expenditure for that asset does not change.
So the marginal cost of streaming it to one more person is almost zero?
Exactly. The cost of building the highway is fixed. The cost of letting one more car drive on it is negligible. That's why scale is everything in this business. And, the report also notes that Netflix uses an accelerated accounting schedule.
What does that mean?
It means they expense and recognize the cost of content over a pretty short period. Over 90% of a title's cost is accounted for within 4 years of its release.
And why do they do that?
It's just fiscally responsible. It matches the expense to the viewing curve. Most people watch a new show in its first few months, so it makes sense to front-load the cost. But historically, this made their margins look tight when they were spending heavily for growth. Now that content spending is growing slower than revenue, this schedule is actually starting to work for them.
It's accelerating the margin expansion we're seeing.
Precisely. And the platform itself, the tech, the cloud infrastructure, those costs are also largely fixed, right?
For the most part, running the core platform, R&D for better compression, those are high upfront costs. But as their user base scales, those costs grow much slower than the revenue. They're always finding new efficiencies.
What about marketing? That seems like it would be more flexible.
It's more flexible, but also highly disciplined. Their marketing budget is remarkably stable, around $2.9 to $3.1 billion a year.
Which is only about 7 to 8% of their total revenue.
Exactly. You contrast that with legacy media companies who are often spending 15, 20% of revenue on marketing. Netflix is lean because they use their own platform for promotion, the autoplay trailers, and they rely on viral social media buzz.
Which keeps their customer acquisition costs low.
And this whole disciplined cost structure leads us to the financial maturity story, the margin expansion, and the free cash flow flywheel.
Yeah, the 10-year history chart in the research report is visually stunning. It shows the flywheel effect perfectly. Cost of revenue, that huge content cost, has compressed dramatically as a percentage of revenue.
What are the numbers?
In 2015, cost of revenues ate up about 68% of every dollar they earned. By 2025, that figure has compressed down to roughly 52%. That 16-point drop is pure operational leverage converting into profit.
And that margin expansion is what powers this radical turnaround in their ability to generate real, spendable cash.
It's the ultimate measure of success for a mature company. I mean, the report highlights this incredible shift from burning massive amounts of cash just a few years ago.
Right, like in 2019, they had negative $3.3 billion in free cash flow.
Exactly. During the peak of the content spending wars. And now, their trailing 12 months free cash flow in 2025 stands at an enormous $9.1 billion.
From burning over $3 billion to making over $9 billion. That's an incredible turnaround.
And that $9.1 billion is hard proof that the model is scalable and has moved past the investment phase. The flywheel is spinning, and it's printing cash. And that cash gives them a huge cushion to weather any economic storm.
We've established that operationally, the business is a cash-generating engine. But financially, the balance sheet is about to undergo this terrifying stress test with the WBD merger. So now let's use the final framework. Assessing Netflix through the rigorous lens of traditional value investing, the Buffett checklist. This is really crucial for separating the quality of the business from the quality of the stock.
Exactly. We need to answer the two parts of our mission. So let's start with the qualitative tests, the criteria that define a truly durable, high-quality business, a wonderful company.
Yeah. First up,
profitability and efficiency. It's a pass. Their net profit margin is exceptional at 23.6%. But look at how efficiently they use shareholder money. Return on equity, or ROE, is at an eye-watering 42.9%.
And for context, anything over 15% is considered really good.
Yeah, they're nearly 3 times that. Their return on invested capital, ROIC, is also incredibly strong at 29.9%. These numbers just scream high-quality operation.
Okay, next, cash generation. Pass. The free cash flow is robust at $9.1 billion, and the report specifically says management has shown elite skill in capital reinvestment.
A key Buffett principle. It's not enough to generate cash. You have to deploy it intelligently, and Netflix has proven they can do that.
And growth and predictability. Also a pass. Even with subscriber growth slowing, earnings per share has grown dramatically, from just 3 cents in 2015 to $2.39 in 2025.
The business is durable, predictable, and highly scalable.
So qualitatively, there's no doubt Netflix is a wonderful company. But now for the quantitative tests, the ones that determine if it's a good investment at this price. And this is where it hits major headwinds.
This is where price ruins perfection.
First, valuation discipline. Fail. The price to earnings, or PE ratio, is around 40 times trailing earnings. So for our listeners, that means the market is willing to pay $40 for every $1 of profit the company made last year.
A traditional value investor is looking for a PE of 15 or less. The price to book is also around 18 times. The valuation is pricing in years of massive, flawless growth. There is absolutely no margin of safety.
And then we get to the second quantitative failure, which is the defining issue here. Balance sheet safety. Fail.
Big fail.
The current debt-to-equity ratio of 0.6 is fine. But post-WBD merger, that ratio is projected to shoot past 2.5.
It's a dramatic, dramatic shift. It violates the core tenet of value investing, which is to avoid excessive leverage.
But wait, if they're generating $9 billion in free cash flow, can't they just pay that debt down quickly?
That's the crucial distinction. While their current interest coverage is phenomenal, their income covers their interest expense almost 29 times, the pro forma interest expense with $60 billion in new debt will tighten that coverage significantly.
And their flexibility disappears.
Completely. They're now highly dependent on the stability of global debt markets. Any unforeseen economic shock could turn that manageable debt into a life-threatening anchor. And that level of risk is just unacceptable under strict value investing principles.
So the verdict is definitive. A wonderful company at an unattractive price facing a massive balance sheet event.
And that financial shift immediately forces a change in capital allocation, that enormous $15 billion share repurchase program.
Which saw $1.6 billion repurchased in Q2 alone.
That's expected to be suspended or severely curtailed through 2026 and 2027. Their priority has to be servicing that $60 billion in debt. Share buybacks are off the table until the balance sheet is fixed.
And the report highlighted a real split among institutional investors on this. Some big names were buying heavily while others were getting out.
Yeah, the market was clearly divided on the WBD gamble. On one side, you have prominent investors like Bridgewater Associates, who increased their position by nearly 900% in Q3.
900%? Why?
They see the $9 billion in FCF as defensive growth, a durable asset with pricing power that can weather a downturn, making the high price worth it.
But the profit takers saw the risk coming.
Absolutely. Funds like Sapient Capital were trimming their positions. They were likely reacting to the extremely high valuation and anticipating the debt risk. They took profits, signaling caution about the market's enthusiasm for the merger.
To bring all of this home, we have to determine what the company is actually worth, its intrinsic value. And because the WBD deal creates so much uncertainty, the analysts modeled 3 distinct scenarios using a DCF analysis.
Right, and we're using a discount rate, a WACC, of 9.5% for all the models. That's intentionally a little higher than Netflix's historical rate, just to reflect the new leverage risk.
Okay, so let's look at the most cautious scenario, case 1. This assumes the market's worst fears come true.
Case 1, the conservative case. This is where the WBD deal gets blocked. They have to pay that punitive $5.8 billion breakup fee, and core growth slows down. Here, we assume a moderate FCF growth of 8% for 5 years. The resulting intrinsic value is only $39.70 per share.
Less than $40, and with a margin of safety, the buy price would be under $30.
It just shows the catastrophic impact of the deal failing.
Okay, that's a huge gap from the current price. What about the middle-of-the-road scenario?
Case 2. The nominal case. This model assumes the WBD deal gets partial approval or stays in regulatory limbo, but the core Netflix business executes well. Margins go up toward 30%. Here we use a much healthier 14% FCF growth rate.
And the intrinsic value?
It rises to $51.55 per share. With a safety margin, the buy price is $38.66. So even in a really strong scenario for the core business, the stock is trading at almost double its fundamental value.
Which brings us to the optimistic case. This has to be the scenario the market is pricing in right now.
It has to be. Case 3, the optimistic case. This is the moonshot. The WBD deal closes flawlessly. Integration is perfect. They get all the synergies immediately. The combined company dominates global media. Ad revenue keeps doubling.
The dream scenario.
The dream scenario. This model uses a massive 22% FCF growth rate for 5 years. And even in this most bullish, high-growth model, the intrinsic value is only $88.50 per share.
$88.50. And the buy price would be around $66?
Right.
So when we compare all of those intrinsic values to the real-world market price, the final verdict seems unavoidable.
The current stock price of Netflix is $96.71.
$96.71.
This means Netflix is trading above even the most optimistic intrinsic value. The market is pricing in a level of growth that not only exceeds historical norms, but requires absolutely flawless execution of a monumental merger that we know is filled with risk. The conclusion is clear. The stock is currently overvalued and priced for perfection.
There is zero room for error built into that price.
To synthesize the core findings of this deep dive one last time for you, Netflix is, without a doubt, a wonderful company. It has an incredible product, a powerful, expanding moat, and it's matured into a massive free cash flow generator.
Right.
But that quality is completely outweighed by the current price. It trades at an unattractive price. And it's facing this profound, transformative balance sheet event of taking on $60 billion in debt, which introduces unacceptable leverage risk.
The quality is stellar, but the price is prohibitive. And that debt event really is the defining moment.
Yeah.
And, it brings me back to that strategic shift we talked about at the beginning. Management deciding to stop reporting quarterly subscriber numbers. That move was criticized as a lack of transparency when growth was slowing down. And, this shift toward prioritizing free cash flow and engagement over raw subscriber numbers, that's a move toward true financial maturity. It's what a media giant should do.
It is.
But it raises this final provocative thought for you, the listener. Given everything we've analyzed today, where revenue and engagement are clearly stronger indicators of financial health, does the market's continued demand for transparency on that old unit count metric really justify the operational headache of reporting it? Especially when management rightly sees it as secondary to long-term profitability now.
It's a real challenge to the traditions of Wall Street, isn't it? Demanding maturity when they still want to see adolescence. An excellent point to end on.
We hope this deep dive into Netflix's Crossroads has given you a much clearer picture. Thank you for joining us on the deep dive.
And a final reminder on the nature of this analysis. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Please conduct your own due diligence before making any investment decisions.